Hi everyone, Joe Gentili from Left Tail Risk Advisors. So in this video, I want to go through tax treaties. So tax treaties are in place for people that have income or in multiple countries, and it's a way for them to kind of harmonize their tax responsibilities so they're not subject to double taxation. And in some instances in the United States, they can get reductions on the rates of tax that they pay on certain types of income, and in some cases, even eliminating it. This applies to a lot of people. There's dozens of countries that have tax treaties with the United States. In my experience as an attorney working with high net worth and ultra high net worth investors in the United States that are putting money in the US and buying assets in the US, many of them are very familiar with the income tax treaties that exist. What a lot of them are not familiar with, and is also very important, is that these income tax treaties typically do not include estate and gift taxes. It's not part of the treaty. And most countries don't have a treaty on estate and gift taxes with the US at all. There are dozens of countries that have income tax treaties, but there's only a handful that have estate and gift tax treaties. And those are largely Canada and countries in Western Europe. So for most of the world and most of the folks, frankly, that I worked with, there was no treaty. And so this is something that's very important to consider because of how high US estate taxes can be, how high the gift tax can be for foreign nationals that don't reside in the US. So, for example, if you're a foreign national and you don't reside in the US, but you own property, say it's a home, a building, whatever it may be, in the US, and you pass, the first $60,000 of the value of that property is exempt from US estate taxes. Everything over that $60,000 mark, so let's say the building is worth $10 million and you have a $60,000 exemption, then almost the entire 10 million is going to be subject to US estate taxes. And that could be 40% right now of the total value. And if it's in a state like New York, where there's additional state level estate taxes, you could end up with over 50% of the value of the property due in estate taxes before anything passes to your heirs. And this money is due within 9 months of death. So it's a huge chunk of the value that's taken out through estate tax, and that money is due very quickly. So there's liquidity that needs to be there to take care of this. And so for most folks, if this is a surprise, it's a problem. If they're aware of it, there are ways to deal with it. So if you're a foreign national and you own real estate in the US, or you're thinking of owning real estate in the US, there's a team of people you really should consult with. You should consult with an attorney and a CPA, both who should be experienced and comfortable with cross-border tax issues. But I'd say you should also consult with an insurance person that's educated in these areas as well, particularly on life insurance. If you already own the property in the United States, I think most professionals are going to tell you that the best way to deal with the issue of the estate tax is through a life insurance policy if you can get it, where you have this pool of liquidity now upon death, this tax-free pool of liquidity that's available to deal with those estate taxes when they're due. So this way it's not causing this huge scramble for cash. And also to think about it this way, if you're going to hold that property for life, it's a way to kind of prepay the estate tax in a sense with pennies on the dollar, because the amount of money that people pay in premiums versus the death benefit, usually that works out. The death benefit's going to be a much higher amount of money if it's a properly structured life insurance policy. If you haven't acquired the property yet, but you're considering it, there's other things or other methods to consider on how to avoid US estate taxes, but those could invite income tax issues depending on how people structure that. And so the point is that it's a complicated area. And so if you already have property or you're considering acquiring assets in the United States, could be a business, really any type of assets, strongly suggest that you consult with an attorney, CPA, and a life insurance professional to guide you on what the best options for you are for you to minimize your tax exposure, both income and estate. So that's what we have today in this video, and thanks for watching. I really encourage you to like and subscribe for future videos on this topic. It's one we're going to go into a lot of detail on. Thanks, bye.